G'day, welcome back to Dividend Investing with Lincoln. So look, we may have heard the term dividend snowball before. It's really all about the compounding effect and the ability to reinvest dividends to continue to grow your income stream and grow your wealth with time. So today we're going to have a quick look at the dividend snowball effect. We're going to use an investment calculator to begin to see what that looks like. This is a very long-term thing. It's going to take decades. You'll just have to be comfortable with that. It's slow, it's boring, but it's certainly one way to begin to build wealth, and we're going to look at a couple of options as well for some specific holdings that you might want to consider as you go through and begin to think about the dividend snowball effect. So stick with me and we'll get into it. Okay, welcome back. So look, many of us do have a long time to retirement, or even if we're close to retirement, it's possible that we might be living for quite a long time. Now think about it. How many people do you know that survive into the 80s or 90s? Now that's a long way beyond retirement and just, surviving for a couple of years in retirement. So we often do need to think about a time frame for investing for decades, even later on in life. Now, of course, if you're younger or if you have young children, if you just started working, you very, very, very reasonably could have many decades of investment and time horizon ahead of you. Now, when we begin to think about this, we can begin to think about the dividend snowball. Now, when we're thinking about the snowball, we're thinking about the impact of compound interest. Now, I know this might seem like a lot of time and money, but if we think about $1,000 and just making a small $100 contribution over time, and we think about a long 30-year time horizon, if we aim for, say, a 10% interest rate, and we're going to go sort of 5 above and 5 below as well, we're going to compound annually even, so nothing complex there, nothing too concerning, and we just calculate here. Now this is a very rough estimate for what the future might look like. Now if we just take a 10% return, now that 10% return for dividend compounding could include both dividend income that you're reinvesting, as well as just the increase in returns for the company as well. So if you're thinking about this over a 10-year 30-year horizon, starting with $1,000 and investing only $100 every month, we would end up with a future value of potentially just over $214,000 in 30 years. Now that's, hopefully going to show you that a small amount of money invested on a regular basis with a reasonable rate of compounding return can increase quite a bit. Now if you're fortunate enough to hit 15% interest, which is admittedly somewhat less likely, you could be in the money for $587,000. So hopefully this shows you a little bit about the power of compounding. Now notice as well that here for the first couple of years, it's mostly just the increase of $100 every month that we're putting in, sort of increasing almost at a linear rate. So just zooming in here, it's almost increasing at a linear rate across here. It's really not until we start to hit this year here, year 15, 16, that the compounding effect begins to kick in. And we begin to see the total return and the total value of our investment begin to creep up substantially. So here, thinking about year 20 here, we're still putting in about, $1,200 a year. But we're going up in value from $75,000 through to $84,000. So we can really begin to see the snowball kicking in at that point. And that's what makes the dividend snowball so beautiful, so powerful for people with a long investment time horizon. Now, if you've got kids, think about this when you're investing for them. If you're close to retirement, think about the fact that you may still be investing for 20 or 30 years out. Now, if you're thinking about this, the dividend snowball doesn't have to be a huge portion of your investment. It could just be a small portion of your investment as you're approaching retirement, with the intention of growing that, leaving it alone, putting it aside, a small segment of your wealth, putting it aside and letting it compound over time with the dividend snowball kicking in, and hopefully, if you're retiring at 60 or near retirement at 60, even by the time you're then close to 80, that could have kicked in, and it actually could be leaving you quite a large value of money through that compounding effect. So that is really what the dividend snowball is all about. It's that ability to take those dividends compound them and grow them quickly. Now next we're going to have a quick look at some of the really good options for this, so just hold on with us. Wonderful. Now look, there's a lot of options out there. When you're thinking about long-term compounding, you really want a safe investment. Now there's very few things that are going to be safer than exchange-traded funds, or ETFs. Now the Schwab US Dividend ETF SCHD has been a favorite for the last several years on YouTube and other places on the internet. Now one of the reasons for that is if we come and we look at these dividends. Now we can see that they pay on a regular basis. We can sort of see that they've been increasing year on year out. So it started, if we take 2012 as a baseline, 2013 increase of 11.6%, 2014 increase of 15%, 9.5%, 9.7%, 7%, 7%, nearly 20% increase into 2019, 17% increase in 2020, and just over 10% increase into 2021. So we can see this regular increase in the dividend payments coming through, which makes this a very attractive package for many people. Now when we also look at this, the sort of the 3-year dividend growth rate is about 9.5%, which is quite nice. The current dividend yield is 3.2%. So you're getting some fairly good dividend income here, as well as the potential to grow that dividend over time. Now if we look at this, if we just looked at the total price change since inception, it looks like it's about 200%. 209% notes down there, but if you take those dividends and you reinvest them, that would have grown to 273%. So we're talking about some fairly nice returns over time. Now I'll cover this SCHD in more detail. Note the link for the video below. It's not a perfect ETF. There are some challenges with it, but it is a fairly solid one. And if we look down at what is being held in there, we'll see a lot of the sort of the normal investments that many dividend investors would like to see. Merck, Amgen, so sort of biopharma, healthcare, IBM, PepsiCo, Lockheed Martin, Verizon, which has obviously gone down quite a bit this year. So we can see many of the usual suspects there represented in the dividend list here of the holdings, but also if you notice here the percentages, it's got quite a high concentration of investments within these firms. So relatively high concentration, but good dividend yield and also a really strong dividend growth rate. Another possible option for long-term compounding is the very, very stable Main Street Capital. So I do enjoy dividend income and I do enjoy dividend yield. Now Main Street Capital is a business development company. They help growing companies. Now, many BDCs invest or lend to growing companies. Main Street also makes equity investments, which means that they actually have long-term growth. Now, this isn't groundbreaking growth. It's not going to, light your world on fire, but it does have some really nice benefits. So if we look at the dividends down here, it has a dividend yield of 7.2%, and compared to SCHD, fairly anemic almost dividend growth rates of about 2 to 3% per year on average. So again, it's not going to light your world on fire. But if we roll through here to the dividend tab, we can see the dividends sort of bouncing around a little bit as well, but we can see quite high dividend yield. Obviously, current yields are about 7%. With those growth rates of about 3%. Now, what does this mean? Well, it means over time, if you hold this, if you held this since 2007 to today, you'd be looking at returns just in terms of price of about 152%, which is not bad. But if you throw in your dividends and you compound those dividends, you'd also be getting a total return of over 400% over that time period. So this is quite good. Now, so obviously BDCs wouldn't be a big part of your holding if you're thinking about this long-term compounding dividend snowball, but it's certainly one option that can get you there. Now, of course, on top of that, there's also a range of other companies like dividend aristocrats, many of which that you'd see held in SCHD that are also really good, safe, long-term compounders. Dividend compounding can be very, very powerful, particularly when we begin to look at some of the dividend aristocrats. So these are companies that have actually continued to increase their dividend for decades, many cases, many decades on end, continually, every year. Now, obviously, these aren't going to, again, set the world on fire, but they have stability. So this is Procter & Gamble. The reason I think of them today is I just noticed that my toothpaste is a Procter & Gamble brand, and I noticed that this morning. So again, increases 7%, 4%, 1.5%, 2.5%, 3.8%, 4%, 5.5%, 9% increase. From 2007 to today, if we look at the total return with dividends reinvested, 190% return. And again, we're not going to set the world on fire. 2.5% dividend yield with a growth rate of about 5% over 10 years and 5% per annum increase in the dividends. So you're coupling that as well, of course, with the price return of the company. Now, is this a good company to buy today? Well, it's hard to say, but certainly when we look at the analysts are expecting that this is a company that we should be investing in with strong buys from 7, a buy from 2, and a hold from 3. The average price target is 154 from these 13 analysts, with current prices at about $146. This gives potentially a 5% upside to the analyst price targets. So here is another really interesting example where, again, if you invest and you compound over time, you have the potential to do really quite well by investing in Procter & Gamble. So thank you for sticking around with us. Now, this is obviously just one part of your investment journey, but this is one of the reasons why I love dividends and dividend investing, is because it gives us this beautiful growth, it's consistent growth with the incomes that keep on coming in year after year, in many cases at growing rates. And that really enables us to build the snowball that just keeps on growing bigger and larger with time. So thank you very much. Now, as we keep on with this journey, I'll be doing more and more analyses of individual companies as well as ETFs and other funds to really highlight some of the amazing opportunities available for us as we go through